Well, tonight we'll be looking at a range of issues associated with the low growth environment, from does economic growth affect returns to surviving in a low growth environment. We'll also look at how to find investments for a tough economic environment and what history could potentially teach us. Welcome to you, Anne. Thanks for joining us today. So let's start off by kind of analysing the views that we had from Collective Insights when it comes to the growth trajectory for the economy going forward, and basically arguing, firstly is what is growth and how do we define it, and are we going to have a low growth environment for a lot longer than we're expecting?
Well, if we look at the way it's been set out here, is this how we want to approach it? What we've done within this particular edition of Collective Insight is that we've said we've really got to tackle the problem from a multi-dimensional perspective. The first is the big macro view, and what is happening globally that's impacting growth? How is that affecting asset classes in general? Now remember, asset classes have a huge impact on what people can retire on. It has an impact on how savings, and should they even bother savings in these kinds of environments? It has huge policy implications, a low economic growth environment. But the second way that we look at the problem is from a micro level. In any market, there are pockets of growth. And we know that there is still growth in South Africa. How do we tease out those opportunities? What do we do about them? And that's more for the investor on the street. But the third impact is there not huge implications in terms of how we need to start thinking about growth globally? We live in a world where the world has now reached a limit in terms of what it can sustain. Can 15% growth of companies exist when resources are limited, when we're running out of space, when the demographics alone are dictating very different thought processes? So we've tried to look at the issue of growth from these three different dimensions, and I think it represents some very, very topical ideas.
I mean, just looking at kind of that issue around sustainability and basically saying the returns that we have seen in the past are unusual, and in fact we're going to be going to the new normal, which in fact is the right normal, where kind of moving towards long-term real returns that are kind of not as inflated as we have seen them in the past.
Yeah, I mean, I'd like to say that just as a starting point, the world knows that they need a new set of rules. They're just not quite sure what that set of rules is going to be at this stage. And there's a whole bunch of work happening, a whole body of work happening around this at the moment. One fallacy, I suppose, that's out there is that economics has somehow failed us as a people group, and that somehow we need a new way forward. George Soros' new, his think group for new economic thinking kind of goes a long way towards saying, well, how do we actually work around these? How do we work around these things? Clem Santa, as a matter of fact, does a huge amount of work around this, where he talks about a new Bulls Please scenario, a scenario whereby you would need a new set of rules as far as a business is concerned. Now, you've got to remember that all of this kind of brings kind of volatility with it. Just have a look at your screen quickly. We're looking at long-term asset class returns here from 1900 to 2011, and it looks at equities, global equities, bonds, cash, gold, and housing. And if you have a look at the mean real returns, that means they are after inflation. Have a look at some of those returns, and then on the right-hand side of the screen, you'll see some of the standard deviation of those real returns. And I mean, I think the starting point, John Roland, I mean, this is something maybe for you. If you're using this as a starting point for asset allocation, you probably could be wrong.
Well, if you're going to look at the next 100 years, or 110 years, you're probably going to end up with a totally different kind of table. So in that sense, you're right. I guess in terms of the relative performance of the asset classes, we can maybe extract some things. But the question is, what's your time horizon? If it's the next 5 years, 10 years, 100 years, these numbers could be very different.
Yeah.
Yeah, and I mean, I think that's the important issue here for me, is, again, setting appropriate objectives for clients and making them understand the kind of structural shifts that are happening globally and what that potentially could mean from a returns perspective. I mean,
this is really the basis of stocks uber alles. When people look at charts like that, they say equities for the long run, and then they go back and they take a look at the last 30 years, where we had almost a complete reversal of you could have gotten bonds for a far lower risk adjusted return than you could have equities. And that turned the whole thing up and down. So back to Roland's point, it's all very specific to the time that you're in.
I mean, Peter Bernstein, just before his death, speaks about the fact that he was in the 1950s, he was an investment consultant in the United States, and he was talking about that structural shift in dividend yields and bond yields and how that happened in 1959, and how literally for the next half of the century, where dividend yields were way below bond yields, but literally before that, they were literally the other way around. And are we not sitting in a situation where that potentially could happen? I mean, on the S&P 500, 57% of dividend yields are actually ahead of bond yields at this stage. Now, we know that they're structurally low at this stage, but what does this mean kind of for the next 10, next 20, next 30 years, especially when we talk about, Anne, what you spoke about just now, that whole economic shift happening globally? And do we have the right tools in order to actually deal with some of that, some of those economic shifts that are happening?
Let's talk about the correlation between equities and economic growth and whether there is one, because just according to one of the studies there, I think it was Ritter 2005, who was of course the author, but saying that there was a negative correlation between equity returns and real per capita GDP growth. So of course, you know, that as a starting point, do you pick stocks in a certain territory because there's growth at a macro level? What are your views on that?
Well, I think what you have to do is you start to have to pull apart what you're asking about. First of all, is GDP a good measure of what growth is in a country? Because remember, what's sitting inside of GDP is also government spending, which is really it's a whole bunch of very macro things that really doesn't give you a true sense of the corporate health of the country. And what drives the market is the corporate health, the economic value that is intrinsic to companies, not to the country. And that's where the disconnect starts to come. Would you?
Yeah.
That's where you have, you know, the measure of, you know, education, you know, education going forward, demographic shifts that are taking place, which don't feed into GDP numbers as they stand right now.
Well, okay, go ahead, Roland.
We also need to maybe just expand the picture a bit and show or discuss the holistic scenario here is that earnings depends on GDP growth. So there's a sensitivity level there that's very important. And at times, earnings is very sensitive to GDP growth, and at other times it's not. And government is an important determinant of how important earnings are as in terms of correlation to GDP growth. So what we have is we have very slow, what I call nominal GDP growth. You've got to include inflation because earnings also includes inflation. So GDP growth is around about 10%, and obviously it's cyclical and changes, but around that earnings is much more cyclical. So you're getting a more volatile time series over and above GDP. The you know, equity growth could be plus 30% or minus 30%. You can't have that with GDP growth. So it's those kind of cycles that are very important when we're looking at asset class returns, is to understand where we are in those cycles. And what determines earnings growth is not just the domestic situation and your GDP, it's also what happens internationally. Many of our companies are internationally integrated, so the EPS in our market and the earnings growth of South Africa is much more dependent on external effects than it's ever been in the past.
Yeah. I mean, I think that's Steve Rubinstein's point that he makes in should a worrying economic growth outlook affect returns? And I mean, that is his article in Collective Insight. He's saying, well, you know, by all means, you know, economic growth is important, but it's not necessarily a signifier of returns. Maybe the price that you pay for your investment is maybe equally important. Just have a look at the following graph that comes straight from the study, and you'll see the correlation, and it's one that we showed to you many times on the show. It shows you the correlation between price to earnings ratios and your annualized 5-year returns for South African equities. It shows you that as you pay up for businesses, well, guess what? The returns that you're going to be generating from them is quite low. But pay a cheap price for businesses, and guess what? The returns you're going to be generating from them is so much higher. If I now show you exactly the same graph, but I now just showed you from an earnings perspective, you can see that the correlations break down. Hence, price is a far bigger signifier in the price you pay for earnings long term, sorry, for returns long term rather than earnings.
Yeah, that's absolutely key. And there's so many investors who make the mistake, particularly when they're looking at emerging markets and other opportunities like that, of saying, oh, there's where my economic growth is happening. I'm going to go into that country because that's where I'm going to get my write-up, without really giving heed to the fact of what are the valuations at that point.
Now, I mean, this is the interesting point here for me, because if you look at the South African market, we are a price to earnings mean reverting economy. That means we run up in price to earnings, and then it quickly cools down again because people become scared in interacting with this market. And I dare say that that's not just the case in South Africa, that's the case right across different emerging markets. Now, if you're using that as a basis for decision making into the future, where potentially you have a complete economic shift, you might be wrong. And this is what makes money management obviously so interesting. I mean, Ronan and I spoke a little bit earlier. He says, well, that's why we're in this game, because we want to try and answer some of these questions.
Yeah. So bottom line, I mean, obviously when we're talking about equities, it's the price you're paying for the future. But of course, then it's all the macro level issues that are going to affect future growth. When we're talking about one of the key themes right now is a world plagued by sovereign debt, inflated central bank balance sheets. I mean, what does this mean for growth potential, specifically in countries where you're seeing high debt to GDP ratios?
I think if we look at an analogy of an S-curve, we all know that certain companies and certain industries go through this S-curve where there's initially very low growth, and then there's rapid growth, and then there's a slowdown. We might actually globally be going through an S-curve as well, and around that S-curve there are these business cycles or economic cycles. And I think in the last 2 decades we've probably had a sort of leveraged kind of society where we had low interest rates or falling interest rates, low inflation. So what happens is you get lots of earnings, and you get people running around getting very excited about the equity market. At some point that cycle or that bubble bursts along your S-curve, and you start entering a new phase, and I think we are in that phase, or 5 years into that phase already, where we have a deleveraging, where people are saying we're not willing to take that risk, so the risk appetite's gone away. Interest rates are still low and inflation is still low, but nobody's got the risk appetite anymore to take up these equities and push.
So what does that mean for valuations?
I suppose you can't say on television we're stuffed, but that's basically what it means. It means that we now have to start rethinking a lot of the old heuristics of how we thought about what are reasonable targets. For example, most asset managers think it's perfectly reasonable to generate a CPI plus 5% return. That is the return that you actually need to generate in order to, over let's say a 25-year period, be able to accumulate enough to adequately retire and still have money to spend during your last 20 years. Well, that's off the table now, because if our expectations of asset class returns is now significantly reduced, getting to that CPI plus 5, that's a real stretch for these asset classes.
Well, in the last, whatever it's been, since George Bush had his second innings to now, the S&P has literally been to the decimal flat. Yeah. So you're not getting any returns, or haven't gotten any returns from equities. And if you want CPI plus 5, you're not getting it from there, and bonds haven't necessarily...
You're in the global market, we're in South Africa. So we've got to make sure we keep
and domestically it's different.
Let's hit pause, and we'll talk about the difference between South African markets, South African equities and global equities, after this quick break. When we come back, of course, more collective insights on the other side of this.